If you had $100,000 to invest today and could only choose one ETF, would you pick SCHD or VOO? One offers nearly double the dividend income. The other owns the biggest and fastest growing companies in America. And depending on when you invested, your answer could completely change. Today we're going to compare SCHD and VOO using the Yieldr ETF Analyzer to see which ETF has the better returns, the stronger holdings, the higher quality portfolio, and most importantly, which one gives long-term investors the best chance at building wealth. And the answer isn't nearly as obvious as most investors think. Most ETF comparisons stop at the dividend yield. Some people simply say SCHD is for income and VOO is for growth. But that's an oversimplification, because what really matters isn't just the yield. It's the quality of the businesses you're buying. It's the sectors you're exposed to. It's the valuation. It's how the fund behaves during difficult markets. And it's whether you can actually hold the investment for 10, 20, or even 30 years. So let's pull up the Yieldr ETF Analyzer and break this down step by step. By the end of this video, you'll know exactly which ETF is likely the better fit for your portfolio. Let me start with the basics. VOO tracks the S&P 500. It owns roughly 500 of the largest publicly traded companies in the United States. SCHD tracks the Dow Jones US Dividend 100 Index. It owns approximately 100 companies selected specifically for dividend quality. On the surface, they seem similar. Both are low-cost ETFs. Both focus on American companies. Both have delivered excellent long-term returns. But under the hood, they're dramatically different. VOO asks, what are the biggest companies in America? SCHD asks, what are the highest quality dividend-paying companies in America? That difference drives everything we're about to see. And the first place it becomes obvious is the dividend profile. Let's compare the dividend metrics. Immediately, SCHD stands out. Its dividend yield is typically more than double that of VOO. If you're investing for passive income, that's a huge difference. Let's look at the dividend history. One thing I love seeing is not just a high yield, but a growing dividend stream. SCHD has built a reputation as one of the best dividend growth ETFs ever created because its underlying companies are continually increasing their payouts. And that's important because inflation never stops. An income stream that doesn't grow eventually loses purchasing power. VOO pays dividends too, but income is not the primary objective. The primary objective is market exposure. So if your goal is maximizing cash flow today, SCHD has a clear advantage. But here's where things get interesting. Higher income doesn't automatically mean better returns. To answer that question, we need to see what you're actually buying. This is where most investors have their first aha moment. Let's look at VOO first. Amongst the top 15 holdings, we can see many familiar names like Nvidia, Apple, Microsoft, Amazon, Google, Broadcom, Meta, Tesla, Micron, Eli Lilly, Berkshire Hathaway, AMD, JP Morgan, and Exxon. These companies have been the engines driving market returns over the last decade. If you owned VOO, you participated heavily in the technology boom. Now let's switch to SCHD, and you'll notice something very different. The names are often less exciting. You have companies like Texas Instruments, Qualcomm, United Health Group, Coca-Cola, Chevron, Merck, Procter & Gamble, Amgen, Verizon, Home Depot, Pepsi, ConocoPhillips, Abbott Labs, Altria Group, and Bristol Myers Squibb. Companies that focus on cash flow, profitability, shareholder returns, dividend growth. These aren't necessarily the hottest stocks. They're businesses designed to endure. And this creates a fascinating question. Would you rather own the fastest growing companies or the companies generating the strongest cash flow and dividends? That's really the SCHD versus VOO debate in a nutshell. But Yieldr lets us go one step deeper. Let's examine the quality of these holdings. One of my favorite features in Yieldr is the ETF quality analysis, because ETFs aren't just collections of stocks, they're collections of businesses, and the quality of those businesses matters. Let's start with SCHD. Looking at the top 15 holdings, which make up nearly 60% of the ETF, we can see that the individual quality scores range from a high of 93 for ConocoPhillips to a low of 42 for Verizon. When we average all of these scores together, SCHD earns an overall quality score of 69. Now let's switch over to VOO, and here we see a different picture. The top 15 holdings, which represent roughly 45% of the fund, have quality scores ranging from a high of 97 for Nvidia to a low of 62 for Amazon. When we average them together, VOO earns an impressive quality score of 87. At first glance, you might conclude that VOO is simply a higher quality ETF than SCHD. And based on the data we're looking at here, that's a reasonable conclusion. But it's important to remember what we're actually comparing. VOO owns more than 500 companies and is heavily concentrated in some of the highest quality, most profitable businesses in the world. SCHD, on the other hand, owns roughly 100 companies and intentionally includes sectors like financials, energy, industrials, and consumer staples that may not score quite as highly on traditional quality metrics, but have historically been strong dividend payers. So while VOO appears to have the edge in quality, SCHD is optimized for a slightly different objective, delivering a combination of income, dividend growth, and quality. And that's an important distinction, because the highest quality portfolio doesn't always produce the highest returns. Market environments change. Different sectors move in and out of favor. And that brings us to the next area, where these two ETFs differ significantly: diversification. Let's take a look. Most investors think they're diversified because they own an ETF, but not all diversification is created equal. Let's start with VOO. One thing becomes immediately obvious: technology dominates. That's been fantastic recently, but concentration cuts both ways. If technology struggles, VOO can feel the pressure. Now let's switch to SCHD. Technology is still the largest sector, but you also get big exposure to consumer defensive, healthcare, and energy stocks. The portfolio looks much more balanced. This doesn't mean SCHD will outperform, but it does mean your return drivers are different. And that's one reason many investors actually own both funds. They're not as redundant as they first appear. In fact, combining them creates something very interesting. But before we get there, let's look at historical performance. Let me pull up the price-return comparison. Now, if we only looked at recent years, many investors would immediately choose VOO. And that's understandable. Mega-cap technology has dominated. But here's a mistake investors make. They assume the next 5 years will look like the last 5 years. History suggests otherwise. Market leadership changes. Sometimes growth wins, sometimes value wins, sometimes dividend stocks lead, sometimes technology dominates. The challenge is, nobody knows in advance which environment is coming next. And that's why chasing recent performance often produces disappointing results. The ETF that looks smartest today may not look smartest tomorrow. Which brings me to perhaps the most important question. Which ETF is easier to hold? Here's something nobody talks about. The best ETF isn't necessarily the one with the highest return. It's the one you won't sell. During bear markets, investors don't struggle with spreadsheets. They struggle with emotions. When your portfolio drops 20%, 30%, or even 40%, can you stay invested? Many dividend investors find SCHD easier to hold because the income keeps flowing. The dividends create tangible evidence that the businesses are still producing cash. For some investors, that's incredibly valuable psychologically, because compounding only works if you stay invested long enough for it to work. And this is where I think many investors get stuck. They assume SCHD and VOO are competing against each other. But what if they're actually complementary? Think about what each ETF brings to the table. VOO provides broad market exposure, technology leadership, and long-term growth. SCHD provides higher income, dividend growth, and quality screening. Together, they create a portfolio that benefits from multiple return drivers. You're not forced to bet entirely on growth, and you're not forced to bet entirely on dividends. You get both. And that's why so many long-term investors build portfolios around a combination of SCHD and VOO. So which ETF is better? The answer depends on what you're trying to accomplish. If your primary goal is passive income, SCHD probably wins. If your primary goal is maximizing market exposure and long-term growth, VOO probably wins. But for many investors, the real winner may be owning both. Because long-term investing isn't about finding the perfect ETF. It's about finding a strategy you can stick with through bull markets, bear markets, recessions, bubbles, and everything else in between. The investor who consistently buys quality assets, reinvests dividends, and remains patient will usually outperform the investor constantly searching for the next perfect investment. And that's the real lesson. Not SCHD, not VOO, but consistency. Because compounding only works if you give it time. If you enjoyed this video, give it a like and subscribe to the channel. And if you'd like to analyze ETFs the same way we did in this video, you can head over to YieldrApp.com and sign up for the Yieldr waitlist to lock in special founding member pricing when we launch. Thank you for watching, and I'll see you next time.